Hey everybody, welcome back. Once again, I'm David Guzy with the Guzy Group. We are a real estate underwriting firm. We've underwritten thousands of deals. We worked on every asset class you could imagine, self-storage, mobile home parks, industrial, multifamily, you name it, we've done it. And for this video, let me switch the screen. For this video, what we are going to be looking at is a very common investor waterfall. You're going to see this in a lot of deals. It's going to be the Pref, return of capital, and then a GP/LP split. So three tiers: Pref, return of capital, GP/LP split. So before we actually dig into the little coding of the Excel, let's make sure we understand what I just said, because you got to understand this. So first off, what is a Pref? You can think about a Pref as interest on an existing balance, like a credit card. If you have a credit card with $1,000 balance on it, you are going to incur interest on that every single month. So if your APR, your annual interest, is 24%, your monthly interest is going to be 24 divided by 12 months in a year is 2% per month. So, every month that you have a balance on that credit card, you incur 2% interest. Now, if that balance goes up, that 2% gets bigger, 2% times the balance, so the interest dollars get bigger. You pay that credit card down, your dollar interest payments get smaller. Pref is the exact same way, but basically it's the investor money that we're holding that we haven't returned. We are paying interest on that. So let's first run through this little example. So in this example, let's say you have a condo, or a multifamily complex. Let's say you bought this. You bought it for $100,000. I don't know where you would get one for $100,000 in equity, but let's say you were able to get one for $100,000 in equity. Year one, no cash flow. Year two, no cash flow. You get some cash flows in year three and year four, and then year five, you have your exit. So how would this work with this waterfall tier? The first thing that has to be paid back is the Pref. Okay, so in this example, let's look at here. Year one, what's the Pref starting balance? It's going to be zero, because we always start with zero. What is the accrued Pref? So what we're going to do for accrued Pref, it's going to be a function. It's going to depend on what the capital balance is. So we know that we put 100 grand of investor money. It could be our money, but we put 100 grand of investor money into the deal. Has any of it been paid back so far? Answer is no. None of it's been paid back. So far we have a balance that we got to pay back of $100,000. This is what we're going to be compounding the Pref on, aka the interest. So in this example, let's assume the Pref is 8% a year. So we would do equals 0.08 times the investor capital balance. Let me make this positive. So we had $8,000 that's owed in Pref. Has there been any payback for it? No, zero. So then what's the ending balance? The ending balance is the starting plus the accrued minus the Pref payback. Pardon my spelling, Pref. It's going to give us our ending Pref balance right here. Has there been any capital return? No, there's been no money at all. So return. So zero. Ending capital balance is this minus this. Let's move on to year two. Let me format this. Year two. What is the Pref starting balance? Well, it's the ending balance of year one, 8,000. What are we going to accrue? We're going to accrue. Let's do this. Start investor. We are going to accrue 8% of the amount that we owe the investors, which is still $100,000. Has there been any payback? No. So what is our Pref ending balance? 16,000. Has there been any capital payback? No. Ending capital balance, 100,000 still. So you can see the longer we go on without paying this Pref, it's going to grow. It's going to keep growing and growing. Okay, just like your credit card, you don't pay the thing, it goes up and up and up. So year three, what's the Pref starting balance? 16,000. What is the accrued Pref? Let me move this over here. Once again, we're incurring another $8,000 because we still owe the investor its entire principal. Now there's going to be some payback. So we have $50,000 to distribute. That 50 grand, it always is going to first go towards paying back that Pref that we owe. So we owe right now, if you add these together, the starting plus the amount that we accrued in year three, we owe 24,000. So we're going to put 24,000 there, and the ending balance of the Pref is going to go to zero. Oops, pulled that over wrong. Zero. Okay. Now we had 50 grand, 24 went to the pref. We have another 26,000 bucks left. So that 26,000 now, since the pref has been paid, could go towards capital payback. And now we're going to pull this over. And now look at this. We made a little dent in our capital balance. So that's great. So let's go to the next year, year 4. Pull that over. Pref starting balance is 0. Now the accrued pref is going to be 8% on the capital balance, but now the capital balance is 74 grand because we paid some of it down. Pref payback, look at that. We have 50 grand once again to distribute from this project. That's amazing. So this 5 grand is going to go towards the pref because that's all we owe. Bring that balance to 0. And now the remaining money, this minus that was the remaining 44,000 is going to go towards paying back the capital. So now look at that. Our capital balance went down to 29,000. So you can see that you pay the pref off, but it's still going to grow as long as you have investor capital that you're still holding. That's what it's growing on. Last but not least, let's look at year 5. So year 5, starting pref balance is 0. Accrued pref is going to be 2,000 because it's 8% of the 29,000. Now the pref payback, we have a big exit here, 150 grand. So we're going to cut all that 2,000 is going to be paid. The pref goes to 0. And now after we pay that 2,000, we have 147 left over. So 29,000 of that's going to go to here, bringing the capital balance to 0. And then after, to see how much we have left over, we're going to have equals this minus 29. That's 117 left over. And that's now we have the GP LP split. And pretend in this case, the GP gets 50%. The LP gets 50%. That means the GP gets 0.50% of this, and the LP is going to get the other 50% of this. Okay? So you can see in this example how it works. First, the pref has to be paid back. Once the pref is paid back and goes to 0, we can start returning investor capital. And once investor capital is fully paid off, then we could go to this final GP LP split. Okay? And if you're to do LP, total LP, and say total GP, total LP payments are going to be, we paid the LP here, we paid the LP here, and we paid the LP here. You add these all together, and then we paid the GP basically just right here. That is going to give us a total of 250,000 in distributions that the LP and the GP got, which to check your math, you got to make sure that adds up here. 250. So that's perfect. What this is saying is we invested 100 grand in a project and it gave us 250 in distributions over 5 years. And the LP got 191 of those distributions and the GP got 58,000 of those distributions. So hopefully from a conceptual point of view, that makes sense. Now let's get into the actual coding in Excel. So let's start off over here. Like I said in previous videos, you want to make this look pretty because once again, this is going to go to investors, and the more they understand the waterfall, the more likely they are to invest. So what do you want to do at the very top? Put your waterfall structure. The first is a pref, 8% pref. The second is going to be a return of capital, and the third is going to be the LP GP split right over here. 60% to the LP, 40% to the GP. The next is the project. What is the project actually going to give us? And that's over here. That's what this was. This has nothing to do with investors, what they get, nothing to do with the GP gets and what the LP gets. This has to do what is the project actually intake and what does it spit out. So the intake is the equity required, and I have a deal that I'm actually pulling from. So these are real numbers from a deal. So this is the equity required for the deal in October, 1.6 million. And that's all for the all 5-year hold. And then what is the deal going to spit out? That's the distributions. And you can see it's broken down into operations and special events. I've said this in many other videos. I'm going to say it one more time. Always separate your operations cash flows from your special events cash flows. In this case, it's not going to matter so much, but sometimes you work on private equity deals and the operations cash flow is going to go through a different waterfall and the special events cash flow. They're going to be treated totally different. So get into the habit of always separating them out. Okay, it's very important you do that. Okay, so we know what the waterfall tier is. We know what the project is producing. And now the question is, what do the LPs get and what do the GPs get? And that's what we're going to do right now. And that's why we get paid the big bucks for this. So let's start off with this. Oh, by the way, as you can see, I pre-populated all the headers for you already. Feel free to copy this from me, use it on your own, or just hire my company to do it for you as well. So let's start here. Beginning of month pref balance. It's going to be 0. Okay. Pref accrued. What is the pref accrued? Well, it depends on the capital balance that we owe. So we have to go down to this one's interesting because these are interconnected. The pref is based on how much return of capital you have. So you're building them together. You're not building one and the other. So what we're going to do is look at the start of month investment owed, 0. We're going to say additional equity owed. And we're going to say it's going to be this right here. I like dealing with positive numbers. So let's make that positive. And we'll start there. Now we're going to go back up here. We're going to say, what's the pref accrued? Well, we know it's going to be on a year, it's 8%. We want it on a monthly basis. So 8 divided by 12. And then you're going to multiply. I'm going to put brackets just to keep it very neat and organized. We're going to multiply that by the amount of capital we're holding for the investors. So that's going to be the start plus the current that was contributed during that month. So that means in month 1, we're going to accrue $11,000 in pref. And now how do we do the payback? The payback is going to be this cash flow right here. And then the end of month balance is going to be the beginning of the month plus the accrued minus any payback is the end of month balance. Okay. So let's go into the next month. The pref opening balance is going to be the previous month. We're going to accrue some more pref, but remember, it's giving us an error because I have to fill this out too. So we are going to, let's leave this blank for now. End of month is going to be investment start of month plus anything contributed minus anything paid back. It's going to give us this total. And for the next month, it's going to start here. Equity owed for any additional equity is going to pull over, leave this blank for now, and pull this. Let's do this. Okay, we're going to come back to this. So with that said, let's pull this over. And I made a mistake already. See this pref, you got to lock it in. So pull that over. Now let's make sure that's right. 8 divided by 12, perfect, times this balance, perfect. Pref payback, once again, where are we getting paid back our money from? It's right here, the total of the two distributions. Do this. Now I'm purposely making some mistakes right now, so you could see how they're mistakes and you can avoid to make them. So let me pull this. You're going to see one right now. Okay, so what are we looking at? We're looking at, here's a balance and the pref keeps accruing. And you can see, so the pref starts at 11,000 for November, accrues another 11,000. End of month balance for November, we owe 22 grand in pref. December, we start by owing 22 grand. We accrue another 11,000. Okay, so at the end of it, we owe 33,000. Nothing's been paying back. And here's the thing, when you have these deals, a lot of development deals are like this. When you have a pref that you're not paying back, this thing grows. It grows a crazy amount. Like, look at this. We don't start paying back any money into this deal until May 2027. By then, our pref has grown to about $324,000. So that just goes to show when you have these prefs, you really got to pay these things back because they just grow, pretty uncontrollably, not in your favor. So with development deals, sometimes pref, they're pretty advantageous for the investor. Okay, so what's happening here? We have a pref balance. We accrue some more. We have some money, finally, $1,000. That, remember, pref always gets paid back first. So the first thing that's getting paid back to is the pref. And now we're finally starting to pay back our pref a little bit. We're paying it back. We're paying it back. Like, we're chipping away on this thing. 20 grand being paid to it. 19 grand, 19 grand, 19 grand, 19. Another 20. Look at this pref. It's being paid down little by little. little by little. It's still growing at 8% on this balance. It's growing at $11,000 because remember, 8% taken into a monthly form. So 11,000, it's growing a month, but now we're paying it back too. So we're paying it back faster than it's growing. What you're going to see is we don't pay it fully back until we have that big exit of 5.8 million bucks. And that's what you're going to see right over here. Now, here's the error I made on purpose. You always want this to go to zero. So you want this number. You don't want it to be the full 5.9 million. You want it to be the total amount of pref you owe, which is the sum of these. So what you want to do is this equation. You're going to say the smaller between this and this plus this. And we're going to drag this. So now what you see is at the exit month, what we're going to owe 105,000 in pref, and 105,000 is going to get paid back. So this is the correct waterfall for how the pref is going to grow and then get paid back. Now that tier is going to be done, we're going to say, what's the cash flow for the next tier? So that's what's here. Before we move on to the next tier, let's find out what the cash flow is. Well, it's going to be the total cash flow minus the amount that we've paid back. So it's in this case, it's going to be zero all the time, but over here. So you can see we have 5.9 to distribute. 105 has to go through to the pref. So 5.9 minus 105,000 is this number. This is going to be the amount for the next tier. Now, that is what is going to go into this right here. So this is where we had the capital balance. We start off with zero, of course. Then we have the investor equity. But how much do we pay back? It's going to be the cash flow for the next tier. And once again, that's basically going to be zero all the way, except until you get to the final month. Now, once again, I made this mistake on purpose. You always want to make sure that this ends at zero. So you don't want to show the full 5.8 million. You want to show the total owed. So this plus this. Let me drag that once again. Okay. So now what you're seeing is basically the whole time that the investor puts 1.6 million in, it gets put in right here. Look at that. That just stays because first of all, there's no cash flow. Then when we start to have cash flow, this stays because all that cash flow is going towards the pref. It stays. It doesn't get paid back until the very end with that exit. And then once again, after we pay back the return of capital, how much do we have for tier 3? So for tier 3, we're going to have this amount minus the amount we paid in this tier. So we're going to have 4.3 million. And just to fact check that, look at this. The project gave us 5.9 million. We paid this much off in the pref. We paid this much to return capital. So for the next tier, we have 4.13 million. So let's drag this over here. Perfect. And last but not least, we have the GP LP split. And in this case, we're going to look over here. So the LP is going to get 60% of this, and the GP is going to get 40% of this as well. And you want to put your little dollar signs here to lock those in, and then drag them across. And these two together should add up 4.13, 4.13. So that's perfect. One thing I want to point out, guys, always make this dynamic. Make the pref dynamic where it's an input, and make the GP LP split dynamic. Just so when you work for a private equity firm, the GP can really play around with the potential returns you're going to offer investors. It lets them know exactly what they should offer. Okay, so what do we have here is the investor waterfall. Now let's show what the LP returns are. Well, let's start out with the project returns and the LP and the GP. So the project, what's the distributions? That's going to be these. And what is the equity invested? That's going to be this one. We're going to drag them all, and let's add these together, equals sum of this. And let's drag these all. And you should learn this little nifty equation. You drag it, command right. Okay? So that's going to drag it all. And what we want to do now is total project cash distributions. We want to sum all the distributions. Perfect. What's the equity invested? You want to sum all of that. Let's make that a positive number. Okay, let's do the equity multiple first. It's going to be your distributions divided by investment, 3.86 equity multiple. And then let's do the project IRR. I say this in all the other videos. I want to make sure I'm very clear with this. Do not use IRR in Excel or in Google Sheets. You want to use XIRR. XIRR takes into account the specific dates that these distributions in these equity investments occur. And if you use XIRR, it's going to be very accurate. If you use IRR, I've seen it be 5 to 6% difference sometimes. So definitely use XIRR. I cannot stress that enough. So cash flow amounts for XIRR are these. Cash flow dates. Here's the dates. And the guess, I don't know why Microsoft does this, but we just put a random number in there. So the project IRR is 3.24. Okay. So now we know what the project level returns are. Now, remember, from the project, the GP gets some of that for being the magic maker here. They're managing everything, finding the deal, selling it. They're creating the value. And then the LP gets part of the returns for actually giving the money too. So let's do the LP first. So once again, in these models, these things are green because this is where the LP gets paid back. Here, the Pref payback, this is where the LP got paid back via the Pref. Here's where the LP got paid back via the return of capital. And here's where the LP got paid back during the GP split. By the way, I realize there's a little bit of nomenclature errors in here. You could just fix these. I'll fix these right now for you. Feel free to change these to whatever you want to put. But LP return. So we're going to do, they get paid this, they get paid this, and they get paid this. Run that over. Perfect. The equity, in this case, all the equity came from the LP. So let's do this, bring that over. And last but not least, add these together so you can get total cash flows on one line. And then let's calculate these. I'm just going to copy a little trick. If all these are in the same format, copy and paste everything. So Control C, Control V. So now see, it just basically transferred all my logic a few lines down. So what this is saying is that on the project level, there was 6.48 million in project distributions, but the LP is getting about 4.8 million of those. The project level IRR was 32%. The LP, the investor, is going to make a 24% IRR. Okay, so you can see how the waterfall that we just built really starts to impact these returns. Okay, last but not least, let's look at the GP. So where's the GP cash flow? Does the GP get paid at Pref? Think about it. No. Remember, Pref is for the LP. It's on the investor balance, the LP balance that we owe them. Does the GP get paid any return of capital? No, because in this case, the GP did not give any capital. The GP gets compensated at the split. Once again, it's not a coincidence that this is colored specifically. I put it blue. That's for the GP. So let's do that. GP, did they give any cash flow? In this case, they did not. This is sorry, not the cash flow. Did they give any equity? They did not. So it's going to stay blank. Okay, so total GP cash flow. Let's add all that up. 1.65 million. Was there any equity invested? Nope. And what's the IRR and equity multiple? Well, we can't do an IRR and we can't do an equity multiple because there is no equity invested. So those metrics in this case basically are not applicable. And now we want to check our work. So remember, the total cash distribution for the project on this project level, if you add all these together, 6.483 million. That is also right here, 6.483 million. If we are going to add the LP returns and the GP returns together, it better equal that amount. So this plus this equals 6.483 million. Look at that. We're spot on right here. So what we just showed here is the project level returns, and then how the waterfall is going to divide those returns, those distributions, some to the LP, some to the GP. And in this case, with these metrics, I'm going to copy this over. Here's the IRR and the equity multiple. Let's say that, and let me copy this too. Let me take this, copy this over here. Let's say your private equity client wanted to play around and they said, hey, let's do a 10 Pref for the investor and let's give them a 70% of the LP split. Okay. Now you can see how we gave the investor a lot better terms, and we can see it right here. Now the investor has a 27% IRR as opposed to a 24% IRR. But on the other side, the GP is only making 1.18 million as opposed to the 1.65 million. So Hopefully this video makes sense. Like I said, we went through this waterfall structure, pref, return of capital, GP/LP split. If you have any questions, feel free to reach out to my email. Once again, theguzygroup.com. We've done many asset classes, almost anyone imaginable, over a thousand real estate deals. So reach out if you need anything. Thanks a lot.